Starbucks is a company that every person watching this video has heard of, and they didn't get here by accident. Starbucks as a company has been very strategic in growing their company to be the largest coffee house in the world as well as one of the largest fast food chains period. However, recently, the stock has been beaten down and is below 25% from their all-time high and 16% down from their recent high. So is this dividend grower a purchase now, or is there something else you should consider before buying in? Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. To be very straightforward, I believe that Starbucks is absolutely a buy right now for people who are in for the long game, which should be most of you. Starbucks can be more volatile than the S&P, but it has also shown its potential to easily outpace it. This is because Starbucks is not just a coffee shop, it's a cultural phenomenon that has permeated societies across the world. Its consistent and recognizable branding ensures that wherever you go, the Starbucks experience remains familiar, and I can attest that every Starbucks I have visited has the Starbucks vibe to it, which is good for customers who want something consistent. This ideology has helped to establish a reliable revenue stream as the company caters to a diverse range of customers with varying tastes and preferences. There used to be a joke that there would be two Starbucks across the street from each other and they'd both be full, but this joke has become more reality than fiction recently. So let's quickly talk about some of the reasons I think it is worth buying or at least putting Starbucks stock on your radar in case it drops even more for an even better buy-in opportunity. Firstly, Starbucks revenue has increased tremendously over the past decade. As you can see by this graph, it was originally around $2.7 billion a quarter over here in 2009, and a bit more than around a decade and a half later, we're at $9 billion a quarter. This is around a 350% growth, which is very, very good. Now, they've been able to do this by introducing new products, expanding its menu, and opening new locations, and the company has sustained its growth trajectory. This indicates that Starbucks is a well-established formula for attracting and retaining customers, which is a key factor for long-term success and long-term investors. This growth is also what allows Starbucks to be able to have this high PE ratio without it being as scary as you may think. It is also why it has outperformed the S&P for this decade. Another reason I think you should really pay attention to Starbucks stock is their digital innovation. Starbucks' investment in digital technology has had a significant impact on customer engagement. This is one of the smartest things that Starbucks has done in a while, and you'll notice that basically every other fast food chain has tried to mimic it. The Starbucks mobile app, for instance, not only makes ordering and payment convenient, but also provides rewards and personalized offers to users, engaging people to come back to the store more and more often. This fosters loyalty and encourages repeat business, contributing to a stable revenue stream. Another thing that is important to note about Starbucks online is that a lot of people spend money on the app and gift cards to spend later. This money that is deposited into the app but isn't yet spent is more than some banks get deposited, and it is cash that Starbucks pays a 0% interest for, which is just insane to think about. One thing that I mentioned in my growth portfolio dividend reveal video that I posted earlier, and one that I'll put a link to in the description in case you want to check it out, is international expansion by Starbucks. The global middle class is growing everywhere, particularly in emerging economies, and Starbucks knows this very well. Starbucks' ongoing expansion into markets like China taps into this trend, providing an opportunity for substantial revenue growth. China's large population and increasing disposable income make it a strategic market for Starbucks' continued expansion. But it isn't just China. Starbucks is trying to pioneer its coffee houses in all sorts of emerging markets, including India and places such as Singapore. This is hugely important for Starbucks' future because although they definitely haven't hit a cap here in the US, they're getting closer to a cap than they are in other places, so the most logical way to make more money is to go internationally. Another thing is it has a diversified product portfolio. Starbucks has recognized the importance of diversification beyond its core coffee offerings. This diversification reduces the company's reliances on a single product and allows it to adapt to changing consumer preferences, which, as you know, is something I think is super important. For example, its focus on food items and tea beverages caters to a wider audience. One example of this innovation is their pumpkin spice latte, which is coming back just about right now. This drink has been around for over 2 decades and is one of their most famous drinks and would never have happened unless they were pioneering to make a diversified product portfolio. Talking about it may sound a bit stupid, but I'm serious when stuff like pumpkin spice lattes is what drives Starbucks to make even more money and keep even more customers. Another thing is that Starbucks has very strong financials, which is something you have to pay attention into a stock because it is crucial to consider for investors. Starbucks has maintained a strong balance between debt and equity, which is an indicator of stability. Additionally, its consistent positive cash flow suggests that the company generates enough funds to cover its operating expenses, invest in growth initiatives, and reward shareholders. Speaking of reward shareholders, the company has a very lucrative dividend history. Starbucks has consistently paid dividends, and while the yield may vary, this commitment signals financial stability and a willingness to reward long-term investors. These dividends provide a steady income stream, particularly in dividend-focused portfolios that also want a mix of growth. Right here, I have a chart of Starbucks' dividend over time, and as you can see that in 2011, they had a yield of 1.5%, but more importantly, they paid 20 cents a share. If you were to hold these shares all these years, they would be paying 10 times that amount, but they'd still be having a yield at around 2%, which is still more than before, but not 10 times as much. This shows that just holding these shares would make it so you get paid tons and tons of money off your initial investment. Another thing Starbucks is super good at is share buybacks. When a company engages in share buybacks, it indicates that management believes the stock is undervalued, and it's also a sign that management has confidence in the company's future prospects. In just the first quarter of 2023, the company repurchased 1.9 million shares of its common stock, valued together at around $200 million. Although this isn't an absolute ton when compared to some other companies, it still is a good sign and a good signal that this company is here to stay and that management believes in future growth prospects will be better than currently. This also leads to increased shareholder value, as the reduced number of shares can lead to a higher earnings per share, also known as EPS. Ultimately, Starbucks stock is one that I rate highly and is why I have it in my growth dividend portfolio. However, as usual, I suggest doing a bit of your own research before investing in this stock. If you need some growth dividend stocks that aren't tech stocks like Microsoft or Apple to add to your portfolio, I heavily recommend Starbucks, but it might not be for everyone. However, I definitely wouldn't recommend selling the stock if you currently own it, and this current drop in price is something I think over the long term will be seen as very, very insignificant. So if you want to load up on some more shares at a lower price, you could definitely do that now. Thanks for watching another deep dividend short review, and I'll see you next time. Bye bye.